Hello, fellow Rebel Capitals. Hope you're well. So there's no other way to describe it other than the dollar is crashing. And I'm going to show you what I'm referring to in just a moment. Now, do I think this is a long-term trend? We're going to get into that in this video because of the way the mechanics are set up with the monetary system. But there is no disputing the fact that the dollar this year has completely tanked. In fact, you'll notice the title. I said this is unprecedented. I wasn't joking. The dollar literally hasn't fallen this much since 1973. Since 1973, the dollar has never fallen as much as it has this year in 2025. So let's go over to the exact numbers here. And we're going to try to, think through what is causing this and going over maybe some backup or some macro data that would back up this move in the dollar. And Brando is saying Peter Schiff. No, it's not because of what Peter Schiff. Sorry, Peter. It's not because of what Peter Schiff is saying. So he's getting the cause. He's getting the outcome correct, at least so far this year. But the cause he's getting incorrect, in my view. But we'll go over that. We'll have some fun. In fact, I just debated Schiff on this last weekend at the Real Estate Guys. We had a fun back and forth. But anyway, let's go over to the Wall Street Journal, guys, because this really sums up what's happening here. And by the way, if you haven't paid any attention to the DXY today, it's trading at a 96 handle. 96. Now, historically, that's actually pretty high. So I don't know if you can say that, overall the dollar is crashing. But this year, I think you could definitely say it's tanked, plummeted. I don't know what other word you would use to describe it. And I can say I would not have expected this to happen. Definitely not expected this to happen to the degree to which it did. But let's go over kind of the facts. So first part of the year, the dollar's kind of churning here. I think it's around 104, 105 on the DXY. And then we had Trump come out with his big announcement, Liberation Day, Retardation Day, whichever you prefer. And the dollar really sells off. Now, there was a lot of things going on there. I think there were some entities outside the United States that were selling dollar assets, that's for sure, because they wanted to. But then there are also entities that were selling dollar assets because they had to, because you momentarily had a quick freeze in liquidity. They couldn't roll over debt. They couldn't get the dollars they need to buy the inputs. Let's say it's commodities. Let's say they needed it to make their debt payments. And what do they have to do? They have to sell any dollar asset that they have to come up with those dollars. And that could have been treasuries, what have you. So you have a multitude of factors that go into the dollar going down and plummeting after Liberation Day. But what was interesting is when this happened, I'm like, yeah, you probably have kind of a snap back because you have all this dollar selling, but the debt outside of the United States, the dollar denominated debt is very short term. So you get to a point where all those entities with the debt are buying what the entities without the debt are selling. See, so that short-term selling leads to the dollar going down, but then you have a snapback because all those other entities have to buy. There's what I call an inelastic demand for the dollar. Now, it's it's not going to represent 100% of the demand, but there's always that inelastic demand that whether you hate the dollar, whether you love it, whether you're impartial, whatever it is, it's always going to exist because that's how the dollars were created to begin with, right? Okay, so, but then we did have a snapback. Now, I thought it would be a little faster, and I thought it would be a little more extreme. I thought we would go back up to, I think when we hit Liberation Day, the dollar was right around 103, and it went straight down to like 98. I thought, it's probably going to go right back to 103. Now, it didn't do that. It went back to around 101 or so, but it did snap back. But then we had the dollar just continue to go down. It's almost gone down in a straight line since that time, since it snapped back to 101. So why is this? Is it because what Schiff is saying, everyone is dumping dollars and the dollar's losing reserve currency status? And no, again, because even if there are entities that are dumping dollars because they hate Trump, they hate the US, they hate the fiscal position, they hate the debt, they hate the big, beautiful bill, whatever it is, and they're dumping these dollars to buy gold or something like that. That's fine, but you're going to have other entities out there that have to buy the dollars. So it's over, let's say 2, 3, 4, 5 weeks, you're going to have a snapback. Now, that doesn't mean the dollar can't gradually decline. Why? Because there's thousands of variables that go into what moves the dollar versus the euro or the dollar versus the yen. And so what I'm talking about are just some of the major factors that go into it. And that's why what I'm talking about as far as the way the monetary system is structured, this is why it's very difficult to have the dollar go down to like 80 or 75. Although it has done that in the past, in order to do that, you would have to have a lot of dollar liquidity. And how do you get that dollar liquidity? How are you going to argue the banks are going to start lending again if the economy, especially the global economy, is contracting, at the very least slowing down? You see, so if the economy was heating up like we saw in the early 2000s, then yeah, I'd say you could get down to 70 or something like that. But the only way that you could do that is dollar liquidity. And the only way you get dollar liquidity is through the banks creating dollars by lending them into existence, which creates that inelastic bid. And the cycle just goes round and around in a circle. But shorter term here, 6 months, year, you can have things that, let's just say, when we're looking at the cross currents of what moves a currency relative to another currency, you can have things that override the structure of the monetary system, such as what I think moved or has moved the dollar from 101 straight down to 96. We'll have to see what happens from here, and which resulted in the dollar having its worst first half in decades. And I'm reading the title right here. And it's not just the worst first half of the year in decades, it's the worst first half of the year since 1973. Right, just a couple years after the dollar was taken off of the gold standard in 1971. So that's saying a lot. I mean, that's a big deal. Even if you're a dollar bull or whatever, this is you got to acknowledge this is pretty extreme for sure. So now let's go over into why I think this is happening, because this pertains to what the downside risk is in the dollar and how it might snap back because of a potential short squeeze. And but I think it starts right here with interest rate differentials, because regardless of these cross currents that move the FX exchange rates, this is a biggie. This is a biggie, and although it's you can't really blame longer term trends like 3, 5 years, but I think shorter time frames, 3 months, 6 months, a year, you can definitely attribute the major moves, especially dollar euro, to what's happening with these interest rate differentials. And I'm talking about the central banks. So let's just assume for a moment. In fact, let's just look at this chart. Look at the black line and the blue line. The blue line is Fed funds rate, and the black line is ECB. Now, this isn't going to necessarily mean the whole curve is moving, but often even the overnight rate leads to these appreciation and depreciation of the currencies themselves, or these big movements in the cross rate. So right here, we've got the ECB. This was 2008, if you guys can't read that. ECB was August 2008, 4.25. The Fed was at 2%. So the Fed really went first. And then the Fed got all the way down to 0, but the ECB stayed at 1%. And they started actually raising rates in 2011 up to 1.5% when the Fed was basically pegged at 0. So now let's zoom out and look at a chart of the DXY. And you can see right around here, this is the time frame when the dollar got down to almost its low in the last, I mean, look at this, 74. And this was right around the time frame when you had the Fed pegged at 0 and the ECB actually raising rates. So you would have that interest rate differential, which was at the very least a huge headwind to the dollar relative to the euro. Okay. But then what happened? Then you had everything reversed because if you guys remember, the ECB not only went down to 0, but I believe they took rates negative by a couple basis points. So that would have been right here. And right around this time, what's the Fed doing? They're starting to increase rates. So here, you would assume the dollar would have a huge, huge tailwind against the euro. So we go back to our chart of the DXY. You can see that's exactly what happened. That's when the dollar went from, call it 80 roughly, to where it is traded for the last 10 years in this range between like 90 and say 110. And so more recently, what has happened? Well, you have the ECB taking rates from 4.5 straight down to 2. And in this time frame, the Fed has gone down, but nowhere near as much as the ECB. So this would have supported the dollar. This is why, or one of the reasons why the dollar was trading at 105. It was because there was this increasing rate differential between the ECB and the Fed. But now what's happening? Now, all of a sudden, I think it goes straight back to right about here. You had the narrative shift where it was all about higher for longer, higher for longer, higher for longer. Our biggest concern is the inflation rate in the United States because of tariffs or what have you. Jerome Powell is talking about, every single time he comes out on the press, he's very hawkish. And the market sees that as, wow, okay, this interest rate differential between the ECB and the Fed is going to be sustained for quite some time. But then what happens? Then you have the data starting to soften. You have the labor market starting to soften in the United States. It gets weaker and weaker and weaker. Now, it's not negative. We'll have to see what the non-farm payrolls are like this week. But we haven't gone all the way down to negative territory, which would be a huge red flag that you're not just headed for a recession, but you're already in one. But regardless of whether we go into a recession that's defined by the NBER, the bottom line is it's definitely getting softer. And another example I would give is just today, we saw the Chicago PMI come out. And actually, I can just go over to the calendar here. And now you got to remember, anything under 50 is a contraction, under 50. And last month, we're at 40.5. And I would assume that's because everyone was all about tariffs. Tariffs are leading uncertainty, uncertainty, uncertainty. You guys heard that nonstop. But this month, they were expecting a little bit of a bounce back because we didn't see the tariffs play out to the degree to which we thought initially. So then the expectations go up to 43, but today we come out at a 40.4. So not only did we miss expectations, but they're actually lower than what they were when everyone was freaking out about the uncertainty around tariffs. So this is just another one of these red flags. This in and of itself doesn't mean that you're in an economic contraction because we're such a service-based economy, but it's not something you can ignore. And I'll be very interested to see what happens tomorrow with construction spending, job openings. Then, of course, we got the unemployment report on Thursday that we'll definitely have to pay a lot of attention to. But it's not just the dollar, in my view, kind of screaming that the Fed is off sides. I mean, if you think that Donald Trump is an influence, which I don't really think he is, but if you believe he is, that he's putting pressure on Jerome Powell, that could be playing into it. But I think it would be more so the data just simply getting weaker. Now, we did have the PCE come out the other day, the core PCE, and that notched up from 2.6 to 2.7. So that would be why Fed Watch went from 73 to 80%. We talked about this on a recent video. But I think this could be an outlier. And you do have the Fed governors coming out and talking more dovish. So remember their dual mandate, it's the labor market, unemployment, and it's inflation. So they have to decide where the biggest risk is. And if the biggest risk is in the labor market, they're going to lean towards cutting. If the biggest risk is in inflation, they're going to lean toward hiking. And if they can't make up their mind, they lean toward pause. And so we're seeing kind of this gradual shift in the Fed governors themselves, where they're seeing the biggest risk being in the labor market, not so much inflation. Really, not the only one, but the major hawk right now, as far as I can tell, is Jerome Powell. So the punchline, or one of the punchlines, is I think this move, not this big one right here. That was all about Trump and just people selling dollars because they had to, selling dollars because they want to, depending on their balance sheet and what they thought of the policy itself. But then you had the snapback, which I was expecting. But this move down right here, I think it's all about interest rate differentials. So it's really the signal that you're getting from the dollar. And by the way, that's being confirmed by the 10-year treasury. I mean, just rewind like a month ago, 2 months ago, when Doge and all this stuff was in the news, and everyone was freaking out about interest rates. Remember, the 10-year treasury was getting up close to, I know the 30-year got over 5%. And then everyone was saying, okay, it's going to 6, 7, 8. We've totally lost control of the treasury market. The Fed's going to have to come out and do QE. And it's all about the deficits. And this is just going to get worse. And you guys remember. But what happened since then? The 10-year treasury goes straight down, straight down. And this is in the face of all this additional supply. This is in the face of the big, beautiful bill, which, if anything, you love it or hate it, the bottom line is over the short term, it's massively going to increase the supply of treasuries. So even in light of that, the 10-year treasury has gone straight down. I mean, let's look at a 3-month chart. So, well, we're about flat over the last 3 months, but this was the big scare here when everyone thought we were going over 5%. And this is when the 30-year treasury got over 5%. This was, looks like May 21st. But since that time, we peak out at 4.6. We're down 40 basis points, basically 40 basis points. So what is this telling you? It's telling you growth and inflation expectations are decreasing. And it's not just the 10-year treasury. Let's look at the 2-year, because the 2-year is doing something similar. And in fact, it's to a greater degree. I take that back. It looks like right around the time everyone was freaking out, it was around 4%, 4.5. And so we're down. Okay, so we're not down as much as the 10-year treasury, but we're down, call it, 25, 30 basis points. So my point is the 2-year is telling you the Fed's way off sides. The 10-year is telling you growth and inflation expectations are decreasing. This is most likely because the data is softening, getting weaker. And then the dollar is telling you it's expecting the Fed to drop here pretty soon and to have that interest rate differential compress. So now the question becomes, what do you do about it? And I actually, believe it or not, did a video this morning on how I'm playing it. I called it the dollar playbook. And it's what I'm doing to profit in this move by the dollar. And if it continues to crash, well, hopefully I'll do well based on this strategy. But if it snaps right back and we get a big short squeeze, well, then this strategy may do well regardless of the scenario. Now, to be clear, it's not a strategy where I'm taking a direct bet on the dollar, but it's a strategy where I'm taking the signals that we're getting right now, what the dollar is telling us, and then how that applies to interest rates. But it's not a directional bet on interest rates either, an outright bet on interest rates. So I put this into about a half-hour video. It's not even edited. It's just me going through my brokerage account and explaining kind of the rationale behind this trade on how I'm playing basically the signal that I'm seeing in the DXY and in this dollar crash, if you want to call it that, or it is literally the most unprecedented move we have seen in the dollar since 1973. So if you want to check that out, Josh put up the link here, and we'll put the link in the description. It's free. You can just, it's how we're building our email list. So it's just this rcp.georgegammon.com/dollar playbook. So it's the dollar playbook, how I'm trying to profit from the next big move in the dollar, or maybe the signal and what the next big move and the current move in the dollar is telling me about the Federal Reserve and what it's telling me about interest rates using the lessons of history, we'll say. We'll leave it at that. How's that for a cliffhanger? You got to check it out tonight. You'll get a kick out of the video. All right, guys, enjoy the rest of your evening. As always, make sure you're standing up for freedom, liberty, free market capitalism, and we'll see you in the next video.